Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron discuss how commodities may fit into an asset allocation. In theory, gold, oil, and even corn can be a store of value and provide opportunities for speculation. And with futures and the magic of margin leverage, it's possible to amplify returns. Further, according to asset allocation research, securities with low correlations and positive expectations can even improve overall risk-adjusted returns. Nevertheless, can we safely assume that commodities will generate positive inflation-adjusted returns in the future? And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So last week we talked a lot about bonds, mostly in the context of the prior discussion on asset allocation, where we talked about how we would design an asset allocation, how we design a portfolio. We went heavy on the stock side, and we kind of didn't touch enough on bonds, but the overall point was when we put together an asset allocation, this is a portfolio, we first think of that mixture of stocks and bonds. Within the stock side, we have domestic, usually U.S. large cap, small cap. We have international stocks, emerging market stocks. On the bond side, we have muni bonds, corporate bonds, treasuries, sometimes mortgage-backed securities, other fixed income. And we really focused on that mixture of stocks and bonds. So an aggressive portfolio would be all stocks. That's kind of our highest long-term return expectation, most volatility. The most conservative would be kind of cash, but we talked about if you had an all bond portfolio, you're probably actually at too much risk relative to inflation. And so ideally, if you're not being as aggressive as possible, again, the 25-year-old investing in the retirement account goes 100% stocks, large cap, small cap, international, emerging markets. Then we start to use how much do we have in stocks, how much do we have in bonds. And one of the things we kind of realized afterwards that there are other asset allocation strategies that will use other asset classes. And today we want to talk about that. And it's a little bit of what are some other asset classes that you could use in a portfolio, in an asset allocation, why you might use them, but also why Trishul and I don't use them or are less likely to use them. So this would be things like commodities, gold, and we'll get to a few other examples of these asset classes, but that's kind of the focus of our conversation today is still the theme of asset allocation, again, because this is the most important part in any portfolio. This is the biggest determiner of your future returns and the risk you take on to get those returns. And we've gone deep on the stocks and the bonds, and that's really what we use. But there are other asset allocation strategies, there are other asset classes to use in an asset allocation. So Trisha, when you first think of other, and actually sometimes these all lumped into alternative asset classes. If you ever hear that phrase, stocks, bonds, alternatives kind of is a catch-all for everything else that's not stocks or bonds. When you first think of alternative asset classes, what's the first one that comes to mind?
I think the first one from a traditional standpoint in terms of what's kind of been around the longest is probably commodities. I think you hear about that a good amount just because of its long history, the precious metals being the ones there that kind of stand out the most from their history, gold going back thousands of years and whatnot.
So I guess even when you say commodities, I feel like that's a different catch-all. Like it's a sub catch-all. So I guess one, do you mind trying to explain commodities, and then what are some of those commodities?
Yeah, there's a bunch that kind of goes on here, but when you kind of think about commodities, these are basically tangible items that are required for either inputs to manufacturing or for consumption at a consumer level, like corn and things like that, or they could be used for a store of value. And these are things like gold, silver, platinum, things like that. And the notion here is these are items that are useful to society for these various reasons, and their prices fluctuate over time. And the notion is for some items that they're very important to how the world works. You think of energy commodities like natural gas, oil, coal. These items are quite vital to how our society works, and their price, again, these prices fluctuate. So whenever you have like a movement of prices, then there's definitely this notion that it can be traded. And then there's two notions to bring up here. One notion is, well, if you're needing and relying on these commodities for your business, what you would hope for is a stable price, and you would use these fluctuating prices as a concern. So you want to kind of stable out the fluctuations through the commodities markets. However, since things are fluctuating, there's the opportunity to have speculation as well. Meaning, when things are moving up and down, there's another class of individuals who would say, wow, this is great because maybe I can predict the way these are moving and perhaps capture a profit. So from these two perspectives, commodities play a pretty big role. The big ones, for example, in the precious metal side, again, gold going back a very long period, where what we kind of noticed is that maybe there's a flight towards safety when markets become disrupted, and gold might go up during those periods. And then, as we know, for gold itself, it's a store of value. So it does have that ability to perhaps store value over very long periods of time, centuries and millennia and whatnot. So I think as far as their utility, commodities are there, and as far as their movement in prices, well, that leads to the ability to profit through speculation.
Okay, so I think there were two things there that I was listening. One is just these commodities have price movements. The value of gold changes over time. I think that's a kind of a discussion on like fiat currency and what people agree is the value of something that I don't quite want to go down yet, and hopefully we can avoid that in today's conversation. But I think the key is an ounce of gold, the price changes because based on other economic factors, people will either find it more valuable or less valuable. And this is usually not from the perspective of creating jewelry or being used in electronics. This is usually just kind of that historical, societal, agreed upon store of value. The other one is things like the corn that you mentioned. And I think for this, you need to explain futures contracts, which I feel like it's going to get really complex really fast. So I'm going to ask you to try and explain it and make sure I am thinking about them in correct ways. Because this is another way where the price is changing, and that's where this trading mechanisms come into play. But like, why is the price of corn changing, and how do people trade on that?
Right. So what we're doing here is we're stepping away from standard exchange traded instruments that are like stocks, for example, on the NASDAQ and New York Stock Exchange, Amex. And now we're talking about a different exchange. This is a futures exchange. And these are different types of instruments. And typically, commodities fall under the futures exchange because, again, they're not typical securities. So they're governed differently. They have their own set of rules and regulations. The SEC, as we know, Securities Exchange Commission, governs the stock side of things. Now, there's a separate governing organization, the CFTC, which governs the other side of things for the futures. So here we're talking about a different animal than your standard stocks. When you think about a stock, it's an ownership of a percentage of a company. And that company will basically go out and create wealth, and hopefully over time the stocks will go up in value. And based upon that ownership percentage, if the company gives out dividends, well, that goes to the owners of the stock. But on the flip side, with the commodities, it's different. It's like a contract that gets created between a buyer and seller on a future price. And this is helpful from many perspectives. First, let me describe the contract. So the contract itself is quite simple. What it says is it has a price and an expiry date and an amount that the contract is priced at today. So what the contract might say is, I don't want to get into bushels or anything, so let's stick to.
I was actually thinking, does corn come in bushels? I was going to ask you that.
Corn does come in bushels.
If I'm a farmer and I plant my corn, and I know I can't sell the corn now, but I can sell it. Okay, I'm not actually a farmer. I don't know how long it takes corn to grow. Let's say 6 months.
Yeah.
Does that sound 6 months for the corn to grow? And I don't want all the other outside economic environment to impact the price I get for the corn. So I'll agree to a futures contract. I'll sell you my corn, and I'll maybe look 80% of my farm because I'm giving some kind of leeway to weather, things like that. I don't know what my actual output is, but I'll sell almost all of my corn at a future agreed upon price. I'll deliver you all of my bushels of corn for, I don't know what a price per bushel of corn would be, for X dollars 6 months from now.
Right, $5 per bushel. I mean, let's say that, and there's a multiply in there, so it gets multiplied to X thousand. But let's say 5. Yes. Yep.
So I will deliver you. What's a good imaginary number? I'll deliver a bajillion bushels at $5 per bushel.
Right. Yeah, we can even say 1,000 just because who knows how big a bushel is either.
That's a good point. I'll deliver yeah, okay, that's a good point. Okay, so I'll deliver googly bushels for $5 per bushel at 6 months from now.
Yeah, in this example, Aaron, you're the farmer, and what's your biggest concern 6 months from now about the price of corn?
I don't want it to go down. I don't want people to stop buying corn, and I've planted all this, and I already made all my capital investment. I spent all the money on seeds. I have to hire the labor. I need all the farming equipment. So kind of all I need is to be able to sell the price of corn for what I expect to sell it for. Just don't want that price to go down.
Right. And Aaron, you're happy if you get your $5. So that's
Correct.
why you would enter into this contract.
I don't care if the price goes up later on. I just need to make enough to pay myself and pay all the equipment and buy seed for next year.
Right. So now in this example, I would be, Mr. Speculator, and I'd take the opposite side of that trade. So I would buy this contract saying, wow, all I got to do is I pay the $5 and I'm going to get this corn in 6 months. So what that basically means is if the price of corn... Yep.
I think the initial contract would be with a um, like a corn distributor, like a grocery store chain, or it'd be like a grocery store chain. They agree to buy the corn that's been packaged by some distribution company. So they also just want to get the corn. They're happy to pay $5, and so they agree to that price.
Yeah,
So,
it's true. You could have hedgers on both sides, or you could have, a hedger, you're looking to hedge out your risk, Aaron, and a speculator on the other side, like me. Or you could have speculators on both sides. So they're all different flavors. But let's say just in this example, I'm the speculator. So I don't really need the corn, but I'm thinking that corn is going to go up in price. So
okay.
that's why I'm going to go into this contract. And I've done some sort of mathematical model saying, and I've looked at my weather patterns and my tea leaves, and I think it's going to be a really great year for corn. Everybody's going to go run out and buy some corn, and it's going to shoot up the price in 6 months.
Okay, so now you are between the farmer and the grocery store of you're going to try and buy corn at $5 a bushel and sell it to the grocery store, or maybe there's a new technology that's going to be biofuels that's going to buy your corn at $6 or $7 per bushel, and you can get you're speculating, and you can get your $2 per bushel, and you'd be happy.
Right. So what's kind of going on here is, Aaron, you're getting some protection, or you're getting your risk mitigated on the price of corn dropping. Mm-hmm. And if corn does drop to, let's say $4 a bushel in 6 months from now, well, you would be really hurting if you didn't enter into this contract. But you're kind of happy because you have your exit price of $5.
Mm-hmm.
And for me, if I held on to this and the price of corn does drop to $4, well, now it kind of is not so great for me because I got in at 5 and it dropped to 4. So I'm kind of like a loser here. I lost $1 per bushel per multiplier of whatever bushel is. And on the flip side, if the price of corn does go up, well, let's say it goes up to $6, Aaron, you're not so sad because you still got out at 5. Your business goes on.
And I'm in the business of growing corn, not in the business of trading financial securities.
Right. And on the flip side, so I have my speculator hat, and I said, oh, great, my model worked. I know what I'm doing. Next time I'm going to buy a billion bushels instead of just 5. And I'm going to make some money this way. So a few things to note here. One is whenever you have these types of contracts, they're a zero-sum game. For every person on one side, there's somebody on the other side. And Aaron, you would be short the futures, and I would be long that future contract. And we'd be kind of tied up in the middle through the exchange. The exchange would be saying, okay, you're a good guy, Aaron. Trishul, you're a good guy as well. You two will do what you're supposed to do, and you can enter into this contract. And here's a couple of things to realize about this contract. Again, zero-sum game, so there's just a winner and a loser. And there is a bit of a spread, so that's where the exchange kind of gets some money, and there's a fee to participate in this contract. But beyond that, what kind of happens is when we enter into this contract, we put a little bit of margin, both of us, into the market, and this margin gets updated on a day-to-day basis depending on which way the market is moving. The price of corn is fluctuating. And what that means is over time, our profit gets updated on a day-to-day basis. It gets marked to market at the end of any given day. And hopefully if things start going in my direction, for example, me being the speculator, well, then it's kind of okay because then, my margin account will just keep going up in value. And if it's going against me, then the CFTC, the exchange, will say I have to put up more money.
So the idea here is you are a speculator you actually don't want to take delivery of the bushels of corn. You are, but kind of you're going to sell that contract to someone else who does want to buy bushels of corn at $5. So
Yeah.
kind of as a speculator, you don't need to pay $5 per bushel for the contract. You're kind of only putting up enough margin to cover potential changes. You only need to put up, say, $1 or $2 per bushel contract because you only need to kind of cover that difference. Where if it goes from 5 to 4, you've already put that money in. There might be a margin call in addition to that, but if it goes from 5 to 6, then you can benefit. So you don't need to put in the full price. And it could work if we made it at $50 per bushel, where you only need to put in $5 worth, maybe. Is there a kind of a standard percentage for how much you need to put in for futures contracts like that?
It's actually it's different per contract, so it depends more on like the volatility of the contract and how much it's expected to move and things like that. And yeah, the more stable commodities or contracts will have a lower margin requirement, and the ones that are more fancy and more fluctuating will have a higher margin contract. But it'll be a percentage of what's known as the notional value, the total value that will ultimately end up trading hands.
Yeah. So if the kind of total amount of corn changing hands is worth $5 million, I'm just making up a ridiculously large number now that I think about it, like a single farm. You might only put in, say, 500 grand, because if corn is considered stable enough, and I don't know if corn is, but it's a kind of based on volatility, likely to trades or finish up somewhere between 4.5 million and 5.5 million. So you only need to put in this case, 10%. But if it's oil and just trading at 150 a barrel, it could go anywhere from like 50 to 300. Then you need to put up a larger percentage of that into margin based on potential like either historical volatility or current volatility or implied volatility, something like that. But yes, the more volatile the commodity, the more you need to put in margin.
Right. And this is determined by the exchange and also the broker that lets you deal on the exchange. So they might tack on more if they feel things are more risky.
Yeah.
So what happens is we enter into this contract again, and it has an expiry 6 months from now. And each day we march closer and closer to that expiry date. And at the end of that expiry date, what's going to happen is somebody's going to expect a bunch of corn, and somebody's going to be waiting to pick up these corns at a predetermined location. So there's going to be a physical exchange of money and corn at settlement. So yeah, as a speculator myself, I don't want the corn. So I will likely be unwinding this contract by going short myself to somebody else. Meaning I'll sell this off and somebody else will take that long position. And the notion here is I can get in and out of this, and as long as I'm not the one holding it at expiry, I'm kind of okay being a speculator in this market. And again, there will be somebody who needs the corn, and that's who finally, those people are going to determine the final price, basically that demand to pick up the final corn, at the end of 6 months. So that's how a simple kind of futures contract example works. And the actual price is determined by market participants, because you're going to have a bunch of people who are speculating and hedging on both sides of the equation, and they're going to be thinking, okay, how much should I pay for this contract in 6 months? Should it be $4.95, $4.97? And where the price kind of meets in the middle, at $5 in this example, that's when a trade kind of happens.
Excuse me, sorry.
No problem. So bless you.
Thank you.
And one kind of distinction here, just to get a little bit more terminology out there, is these are called futures, and they're kind of the cousin of something called forwards. And just the high level difference between the two is the futures are very set in stone kind of contracts with set in stone parameters. And the forwards are a flexible version of the futures. So with corn, for example, you would have futures that come out every 3 months or based on the cycle of corn or however it happens to be, but it's all kind of standardized. So everybody knows what's in a futures contract for corn without reading all the fine print details of the contract. However, with a forward contract, it's a little more flexible. It could expire on some random date that the buyer and seller decide upon. And it might have, instead of a fixed round number of bushels, it might have 237.5 bushels or something like that. So it just has more flexibility, but at this point, it's a little more one-off-ish. So that's how you might think about a forward contract versus a futures contract. And you can understand that people might like futures contracts because they kind of know what they're getting. They're all kind of standardized. And in some cases, people might like forward contracts because sometimes you need something a little more specialized. If you end up with a field of purple corn and you can't really sell that on your standard contract, there could be a forward contract out there that somebody would be a potential buyer for the purple corn.
Okay. So I guess can you have forwards contracts of physical commodities, or I guess the things like corn, lumber, because I for some reason when I thought of forwards contracts, I was usually thinking of trading usually either financials or currencies where they're indices or like other financial instruments where you kind of like you can make a forwards contract based on the change between US dollars and yen. You can make a forwards contract of what the S&P 500 will open at or close at the next day, something like that. I did not know forwards contracts could be the physical commodities.
So there's been a lot of evolution, but the way it kind of began is with the forwards contracts. They were there initially, and then I'm paraphrasing and simplifying, but somebody said, oh great, these are forward contracts, really help us out, we can tie things together, how about we standardize it? And we'll only standardize it for the things that are the most common, and we'll put them on an exchange. So forwards were traditionally over the counter, meaning you just kind of agree upon it between an intermediary broker. Okay. And it's, just saying over the counter, here's a contract, you look it over. If you like it, sign it. If not, I'll find somebody else. And then the standardization with the exchange traded contracts on a futures exchange were meant to basically, again, make things more streamlined for very common things that always end up being traded every year. Like tons of corn needs to go switch hands that are very similar in nature and whatnot. Now, traditionally, the FX side has been on the over-the-counter market. And it's tough to, set up a futures exchange because, again, things have to be standardized, meaning you need enough volume to have to be worth it to go out and create, an instrument that is regularly scheduled to be created. If there's not enough demand, then it's just too much overhead. So that's why traditionally the futures were like a subset of the things that were traded in this fashion. And on the forward side with the FX, traditionally it has kind of been over the counter because you have all these different FX markets all across the world, and just kind of finding a one true price is a little tricky because you have just so many trades going on all over the place, not just through a centralized exchange in one country or a few different places, but pretty much, you can trade FX at your local, shop, and they'll have their spread, and another country will have tons of little stalls everywhere and so on. So it was definitely more of an over-counter situation with the FX. However, lately there's been a lot of blending. For example, you can trade FX on a futures exchange, and you can have many futures contracts that were typically over the counter in the past. And also, when things are vice versa, it's certainly feasible to have kind of whatever you want to be over the counter at this point, because it is technically, just over the counter. This is a contract for something at a future date.
Okay, really quick, remind me FX again.
A foreign exchange.
Okay, that'd be the currencies.
Yeah, right.
Okay,
it's
so
a
euros
word
and
for
yen
currencies.
and won and pesos and dollars.
Yeah, and when you talk about currencies, we're talking about pairs because you're trading one for another. So EUR USD, Euro dollar, or CAD USD, and USD JPY. These are, there's maybe a half a dozen major pairs, and then everything else is called like the minor pairs.
Okay, so between oil, gas, precious metals, and corn, lumber, and other futures contracts, kind of going back to our original part of the conversation, how do these things fit in an asset allocation? Like, if I understand that you can speculate on these different asset classes. So should we be combining some gold or oil or corn and lumber into our asset allocation?
So the headlines are sometimes, we hear these now and then. These things do move. We'll hear that, oh, wow, gold dropped 20% yesterday. And look at oil. It's spiked 30% in the past 6 months and whatnot. And what people kind of think in their minds is, wow, look at all this movement. And, you always hear about that person that said, I bought that platinum thing for whatever, and it doubled in the past year and whatnot. So these things do move, and they do move up on time, over time on average. So they do have a positive expectation. Now that there's a caveat there, but they do move up in nominal space, meaning if you don't account for inflation, over time, they do have a positive return.
But okay, so now like there's a huge implication there. What about in terms of real return?
Right. So that's the big caveat here. So long-term prices for many commodities, now that's a blanket statement, so we'll dig into some nuances. Long-term, the price of commodities tends to be aligned with CPI, which is the price of things, right? Things go up in price over time due to inflation, and commodities fall under the group that we call things.
Okay, so if commodities long term expect to follow inflation, but have significantly more short term volatility, why would you include them in a portfolio? What's the case for including them in an asset allocation strategy?
So there's probably two cases. One case is just because it moves up with CPI, which is like 2%, that is not too exciting at all, especially when you adjust for inflation and that turns to zero, because that's how inflation works. So just, the 2% isn't too exciting, but, some years you might hit 20, 30% up, and some periods you might hit 20, 30% down. So there's a good amount of volatility there. And again, on the futures exchange, you can go both ways pretty easily. You can go short and long. So if you're good at predicting the movements of these instruments, then you could potentially make a good return stream. And there's a whole class of strategies out there that are designed to predict these movements. These are known as CTA strategies, or commodity trading. Oh boy, I should know what the A is, but let's just say it's
Commodity Trading Advisor.
Or advisor. Yeah, something like that. Yeah. I should know more because I used to run a CTA.
I thought you were a CTA. Yeah, I thought it was Commodity Trading Advisor.
Right, and then what basically happens with the CTA is you're advising on commodities that are traded on the CFTC, and the goal here is, investors will give you money, and you'll take that money and you'll in either sub accounts as separate accounts for each individual. You advise on what makes sense. Usually it's tied to some sort of speculative trading type of strategy. Or you'll pool that money together in like a hedge fund model. So it's a commodity pool of money, and you'll kind of run it like that, where people invest and you'll make good trades and then you'll send profits out. So you CTA CPO, commodity pool operator, is the language of people who speculate in this space. And
So they are
again, the goal here is to make a profit. Yep.
So they are actually trying to use that speculation, and just the commodities just happen to be what they are able to predict to produce excess returns. They're taking advantage of the volatility and the fact that it sometimes does go up, and they can go short or long different asset classes. And kind of this would be like almost like active management at its I won't say peak, but it's like the most possible active strategy, I guess you could say, where it's not even like there's almost no such thing as like a closet indexer. This would be a mutual fund who kind of is an active manager, but owns a lot of what their index is, and so they have a pretty high correlation with their index anyways, just higher fees. This sounds like it's like a pure active management strategy. You're really trying to get all the alpha here.
Yeah, there's a lot of words that come into the space, like absolute return, meaning trying to get a positive return in most situations. And also the type of strategies that are common in this space are trend following strategies. Basically, you have strategies that are looking for trends and patterns and trying to be, with the trend or against the trend, like contrarian to the trend. So it's definitely a space where there's a lot of fancy stuff going on, and it can get a bit exotic. In the space I used to be in was in the volatility space on the futures side. So we covered the VIX before, but in addition to commodities, there are also financial futures that get traded on the CFTC. And these are futures on the S&P itself and also the volatility of the S&P. So as I mentioned, with futures and over-the-counter instruments, there's just a large growth in all the different various things that could be traded, just because a lot of people like trading, I guess. And one of the things that is available on there is the ability to trade the VIX in the form of a futures. So this is the volatility of the S&P on a futures contract. And that's, again, a strategy where you can look for these patterns of reversions or trends and try to make a profit.
Okay. So if sounds like it's possible, at least someone out there is making money trading with commodities, why do you not include commodities in your asset allocations?
So it's a very hard place to kind of be in. We've kind of gone over many reasons why a passive notion is sensible, but what kind of has to happen is a few things. One, a strategy needs to be developed, and then you got to find that person who has that strategy, and then they're probably going to charge a good amount of money, because nobody kind of gives away money making machines without charging the cost of a money making machine. And you have to hope that money making machine works and it doesn't end up stop working before you get your money out. And then you got to find a new money making machine. So it's a very hard business to be in on the inside, because there's a lot of competition to make money making machines. And a lot of people are trying, and there's been a lot of horsepower that's kind of been thrown into the industry. These patterns that initially individuals were looking for are now being looked after by computers, and they're searching for all of these different movements, and there's just a lot of horsepower that's going after these types of things. So it's a very tough industry, and at this point it feels like things have gotten each year things get more and more competitive, so that it's kind of hard and harder to get these trends and squeeze more juice out of these types of strategies. That's my personal take. CTAs are probably alive and well in some stance, but I think either the high level initial expectations were that you might be able to get an absolute return, maybe mid to upper single digits across any type of environment. And it's kind of tricky to squeeze that much juice out of something that has a mean return of CPI. So that's why I kind of find like it's a hard place to be in.
What about like a passive? Is there like, I know there's like a gold ETF. What about like a passive commodity strategy? Does that make sense at all, or is that just going to be inflation with volatility? Like, does that actually? I'm trying. Like, does the volatility make it a worse risk-adjusted return, where you have the volatility but your return expectation is below equities, or is there a correlation component that would help the risk-adjusted return of a portfolio?
So what you kind of get is a volatility that's similar to the equity markets, but an average return that's far less. So, whereas stocks, you might get a mean return of 7% plus minus 7% at the first standard dev. I made that up, but let's say that's it. Well, here you might get, plus 2% with commodities plus minus 7%. So, the long-term positive trend on average is again around 2% like CPI, whereas the long-term average positive return on stocks is much higher. So you're kind of fighting against a tough battle where, your average return is much lower, even though your volatility is about the same.
Could that, because we've talked about bonds have lower returns, and I guess they also have lower volatility, but like, is there a way that commodities in a portfolio could help the portfolio in that we talk about the sum of the parts is some of the whole, the whole is greater than some of the parts. There we go. The whole is greater than some of the parts when it comes to asset allocation. Is there an effect like that with commodities in portfolios?
There's probably enough people who say yes and no on both sides of the coin for this question that, I can probably just shrug, but I could give a few anecdotes. For example, let's say 10, 15 years ago, commodities were frankly all the rage because of two things. One, people realized that you could kind of package these more easily. These exchanges started to just see higher volumes and more creations of different types, and then more products, and then more allocations from institutions and whatnot. And this started driving up the price of commodities, in addition to the fact that there was a lot of understanding that the world is becoming modernized and a lot of developing countries are becoming more developed, and there's a limited amount of commodities in overall. And somehow there was this mindset that the price of commodities will outpace CPI on a go-forward basis. Now, in my mind, I don't think that's sustainable. There's something there in the math that doesn't quite work in my mind. But let's say that was true for that period. Well, at that point, then yeah, there was a very strong bent to include commodities in one's portfolio. And the models showed that, yeah, it does make sense because you have a lower correlated return to traditional markets. Many would say, negatively correlated in many situations. And you have this positive upward drift, this return that potentially outpaces CPI. According to some people. And in those cases, if you model these types of portfolios and you throw in a chunk to commodities, it does look better. And, if every other professional institutional portfolio is doing it, why not do it as well? So I think that was kind of the mindset that was pretty common 10, 15 years ago. But I think the higher overarching trend we've kind of seen is, commodities haven't really outpaced CPI even in the last 20 years, let alone the last 2000. And, the reason I say 2000 is this is an example we brought up 2,000 years ago, maybe sometime last year, maybe. But
the cost of the toga or the cost of the clothing was about the same as the cost of a full suit now.
yeah, well, what I think the anecdote I remember hearing about was the Roman army soldier was paid in gold about 2,000 years ago. And if you take that price of gold and you convert it into that same amount of gold, that is, call it X.
1 ounce per gold per week.
Something like that. But basically, you take that same amount of gold. Like if that soldier took that gold and put it in his pocket and saved it for his great great grandkids, and that great great grandkid took that gold that he earned in that 1 year and cashed it in, you would get about $40,000, which is the salary for a soldier today. So basically, what that individual would get from 2,000 years of positive increase in price of gold is the same amount of value as he got 2,000 years ago.
Yeah, I had heard the anecdote. It's like a toga or a full set of clothes cost about 1 gold coin, and something like a nice high-end full set of clothes, like a full suit, still costs about the same as 1 gold coin, something like that. But yeah, I'd heard similar anecdotes going back to Roman times about how well gold has matched inflation over, again, 2,000 plus years.
Right. And we've heard, for example, that gold, we've always heard there's going to be a flight to safety, so why not load up on it? But again, that requires a sensible amount of timing so that you're in and out to actually get that larger, 20-30% return rather than that long-term average of, 2%. So that's the tricky part. And, frankly, I'm on the side of there's not enough bang for the buck for it to be sensible to include an allocation to commodities in a portfolio. Again, a low return with a high volatility. I'd rather go for the high return and the high volatility you get with stocks, or the low return and the low volatility you get with the bonds. But kind of with gold, you kind of get the worst of both. Or commodities in general, yeah.
Okay, well, thank you for teaching me all about commodities today. I really appreciate it.
Well, thanks, Aaron. I enjoyed this conversation. I'll just throw in one or two small things that I had kind of wanted to bring up. One thing that is kind of helpful with the financial futures, you can kind of mull on how important this is to an individual, but they do get preferential tax treatment. Meaning, I mentioned your mark to market on a daily basis. Well, every day, your gains and losses get kind of tabulated, and you get a 60-40 preferential treatment. So 60% of your gains are automatically set as long-term and 40% short-term. So that's just something to realize, that there is some sort of benefit from a tax standpoint versus trading these versus trading traditional stock, where if you hold it for one day, well, that's 100% short-term. Whereas here, nope, you actually get a little bit of benefit on a tax standpoint with commodities, with the futures.
Okay. I did not know that.
Yeah, so that there is some benefit there. And then the other thing, though, is commodities known as precious metals are also taxed differently than your standard stocks. So that's also something to realize. We know that your stocks, your long-term capital gains are 15%. However, if you have the actual physical bullion, it's taxed at 28%. So you got to think about the notion that this won't be as tax efficient as a standard equity investment either.
So that's probably, so I guess there's a difference if you had, actually, I guess it depends on how you own the gold. Because do you happen to know if the gold ETF owns physical gold?
So it depends on the bullion. And the distinction we're trying to make here is, under certain cases, the government will classify gold, a precious metal, the physical gold itself, as a collectible and charge it the collectible tax rate of 28%. So there are some ETFs that if they're holding the physical bullion would get taxed at that higher rate. I think they've gotten a little smarter in how they construct the ETFs, but you got to be a little careful there.
Okay. Anything else that you want to add when it comes to commodities?
I think, this is a good dive enough to say, there is some good stuff going on here that might be interesting, but you're not losing out on too much if you don't have an allocation to commodities in your portfolio.
So we being financial advisors in general have acknowledged that commodities are an asset class that you can invest in. But when it comes to helping you achieve the returns that you need or the risk-adjusted returns you need for your lifestyle, stocks and bonds are still kind of the best way to accomplish that. And they're much more liquid, much lower fees, and kind of longer track record of long-term expected returns and volatility.
Yeah, right on. Good stuff, Aaron.
Again, thank you. I learned a lot today. I really appreciate it.
Thanks, Aaron. Yeah, I always learn things when we have these conversations, and I appreciate the opportunity to go over this stuff. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.